Inflation has hit a very high number recently in the United States of America. 7% something. Who cares what it is after the decimal point? 7%. Unbelievable. 7% inflation. But Jeff Snyder, the head of global research for Alhambra Investments, wants to bring to our attention that maybe it's not inflation, maybe it's a consumer price increase. And maybe if we look into the details, we can learn whether or not this is going to be a persistent long-term sort of increase in consumer goods, or is it caused by money? What is causing this increase in consumer goods? We're going to talk about it. And Jeff, it's not just your opinion. By the way, ladies and gentlemen, my name is Emil Kalinowski. It's not just your opinion. You start right out in this article that we're going to use as our springboard, asking a very important question about a big market that says, how is it that U.S. Treasury rates out in the independent longer end of the yield curve have now suffered a 7% CPI to go along with a double taper, double speed, and triple, maybe quadruple, if the whispers are to be believed, rate hikes this year, and yet have weathered all of that allegedly bond-busting brutality with barely a market fluctuation.
Is it a market fluctuation? You hear the mainstream media talk, and it's like the biggest bond sell-off ever in history. It's like 1994 times 100, right? But yeah, I mean, the 10-year Treasury yield was like, what, 136, 137 at one point a couple of weeks ago. Now it touched 180 earlier this week. I mean, that's not really much of a sell-off. That's basically a market fluctuation. And we saw a bigger one last year at this time. Okay, so we've got the Federal Reserve is tapering at double the pace. It's going to hike rates maybe 3 times, maybe 4 times, and those are going to extend out into the future. And now we have this massive 39-year high CPI, 7%. Sounds like it's more at home in the 1970s. And they've been coming one after another. We've been seeing these accelerate over the last few months. So something's not right here, or at least something doesn't add up to the mainstream idea that this is the great inflation 2.0, where we have inflation not just at 7% today, but supposedly it's going to go on and on and on forever. And if we use the bond market for anything of value, the bond market is telling us no. So where are we going wrong here? Why are yields staying low, whereas CPI seems to be only going higher? What is the disconnect here?
I was on the radio this week, and radio came in, and I was asked that question. I was asked because gold prices hadn't reacted. They haven't reacted to the inflation, which was very, very high. And my answer was, well, maybe it's not a monetary inflation. Maybe the private banks are not creating a lot of money. Maybe the Fed isn't creating a lot of money. Maybe government spending isn't creating a lot of money. And that's what gold may be reacting to. And I suppose the same is true of U.S. Treasury rates. We're going to talk about it in detail in part 2 of this episode, because you just said we have had a rout, the lowest bond prices in 2 years. And in part 2 of this episode, we're going to talk about another time where we saw something similar, the worst bond rout in 7 years, the highest yield in 4 years. So we're going to get into that a lot in part 2. But if we just look at the CPI number itself, the December reading was interesting, Jeff, because it was a little bit different than in previous months. In previous months, we were saying used vehicles, car prices, and oil. Was that the same this month?
It's basically the same proportion this month, but oil prices on the monthly basis, they were actually, oil, therefore gasoline prices were actually lower in December. So December's acceleration over November, this time wasn't all about gasoline. In fact, it wasn't about gasoline at all. It was about other things, which kind of makes it seem like, okay, we've got inflation or consumer prices rising in these narrow channels of automobiles, used cars especially, and then gasoline prices. But now it wasn't gasoline prices. Yes, car prices accelerated a bit in December, but it was, the prices of all other goods actually accelerated too. Are we actually seeing inflation broaden out beyond just those narrow channels? And in one sense, yeah, it's reaching more of the goods economy, likely in response to the frenzy before Christmas and everybody trying to get their presents to deal with the supply and logistical issues that have plagued the goods economy for the last couple of months. But overall, you look at the prices of goods in the CPI, they've accelerated, but then you look at everything else, and remember, the services economy and outside of goods is by far the larger component, and it's not the same at all. In fact, it's going actually in the opposite direction. So if we're looking for clues as to what the bond market sees, we're not going to talk about QE and bond buying and all that stuff because we've done that to death. So the bond market is skeptical about the CPI. When we look at the CPI details, we see any number of reasons why that might be the case.
Very quickly, you mentioned in this article that core CPI rose 5.45%. Back to that idea that it's not food and it's not energy. Even the core number is rising. And you've got a graph here that shows all other prices rising. So to your point, again, maybe this is going to be it. Finally, in December, we're seeing a broadening of an increase in prices. By the way, ladies and gentlemen, if you wanted to play along and read along or sing along, you can do so by going to Alhambra Investments, going to articles that were posted on the 12th of January, 2022, and finding one that was titled US CPI reaches 7 on US goods prices with disinflation setting in everywhere else, including US services. You just mentioned it, Jeff. Okay, goods. You've got a graph here that shows the camel humps. So we've got the two camel humps, and now we can see the head. We see that in that graph.
Is that what it is? I was thinking it was a third camel hump. I guess that wouldn't make much sense, would it? That would be a weird camel. So third camel hump, the head of the camel, something there.
You obviously didn't grow up in Arizona, Jeff. Camels only have two humps. That's the head. And you mentioned me even by name in here. It's very sweet. Mother's very proud of that. I appreciate that, Jeff. Okay, so we see it in the goods CPI, another two humps plus the head, and it hasn't really come down in the goods. It's like 3 months in a row where it's at an elevated level, month to month. We'll see what happens next. But you're saying, wait a minute. Maybe that was just Christmas. Maybe that's logistics. Maybe it's a supply-demand imbalance. Maybe it's everyone ordering online rapidly. Remember, in 2020, all of a sudden we shifted rapidly to online ordering versus gradually, not allowing the supply chain to adjust gradually. When we look at services, which you here define as services less rent of shelter, we don't really see that camel's head, do we? What do you make of that?
We have the double hump and then almost nothing. There was a rise in October, consistent with everything else, and more of what we're going to get to. But since October, November, and now December, services prices have actually decelerated down to some of the lowest monthly rates in the entire series. Again, we're down to about 0.1% month over month in December, which is incredibly low. And it's the opposite of what we see in the goods economy. So if we're talking about inflation, real inflation, monetary inflation, to use your term, Emil, I'm actually getting normalized to it, so maybe I won't hate it as much.
You cursed me in an article, in another blog post. You cursed me, and you said, yes, monetary inflation.
You're going to get me to use that term over and over, and I'm actually going to like it even, which is boggles the mind.
I threw you off.
Anyway, so if this was if this was real inflation due to money, we wouldn't see services decelerate so radically and persistently as it has really since the early part of last year. So yes, consumer price increases and acceleration is broadened out, but only in the goods sector. Outside of the goods sector, it's a very different story, which again raises our levels of skepticism to say that this is not monetary inflation in Emil's vernacular and jargon. It must be something else specific to goods, which, oh, by the way, we've been talking about supply shock and supply chain issues in goods all along. So in the U.S. services economy, there's actually two things here. Number one, it's not acting like inflation at all. Number two, it's more consistent with disinflation and troubling levels of indicated demand and activity, which kind of goes along with the whole growth scare thing that developed over the second half of the year. So not only do we not see accelerating price increases in services, we're actually looking more downside-ish than anything else. And then, of course, then we start looking elsewhere around the world. Which one is going to split the tie here, so to speak?
We're going to talk about China next, but a very quick detour. You mentioned that it's not being caused by money. We're not going to talk about it in this episode, but you've been writing a series this week about the Bank for International Settlements derivative data and how that data is representative. It's an avatar of money. And we don't see growth there. And I bring it up just as a detour in case you wanted to mention it, because you do include a couple of graphs here in this article showing that BIS data. Jeff, did you want to say anything about that more than I just said, other than derivatives are flat, therefore money is flat, therefore we should not expect monetary inflation?
Yeah, there's really not much you can say briefly other than just what you said. I mean, otherwise, we get into a very long discussion about what the derivatives are actually showing, and it's basically a proxy for balance sheet capacity overall in the monetary system. If we don't see derivatives go up, we sort of imply from that that there's not monetary expansion, there's not balance sheet expansion. So if this was monetary inflation, to continue to use your term, Emil, we would expect that we would have seen long before now the money for it. And bank reserves, as we've said time and time again, are not money. They're not used as money. So that's not any kind of useful indication for inflation. This derivative stuff actually is. And the BIS data shows pretty conclusively that since 2019, derivative levels have actually fallen. So we're moving in the wrong direction rather than even in the right direction by not even enough. We're moving in the wrong direction as far as derivatives goes, which is an indication that no, there's really not the money globally behind this, as we know from other proxies like TIC or Z1 or some of the other data too. Again, inflation, monetary inflation, there isn't the money, so there must be something else going on.
We started out talking about United States consumer price inflation. Right now, we just talked about the BIS data, which represents the world, at least advanced economy, money center banking activity, which, I don't know, 80% of activity, let's say. Now let's continue down that worldly path and talk about China. You've got here producer prices. Jeff, what correlation is there to consumer prices in the United States? What can we learn here?
There's actually a pretty good one. If you look at the Chinese data monthly versus the US CPI data, services in particular monthly, you see the 3 gamma humps, the 2 gamma humps in the head, whatever it is, they appear in both almost exactly simultaneously. And you know, the point that you just made, Emil, about the BIS being global data, global money, when we talk about actual inflation and economic conditions, even treasury yield, what we're really talking about is this global monetary system. Therefore, inflation, real inflation, isn't about just the US. It isn't about just Europe. It's a global situation. It's a global phenomenon because it's a global monetary system. So maybe there are times when the US CPI can go up, but if that isn't matched, or if that isn't corroborated by inflation data around the rest of the world, then we're looking at idiosyncrasies that probably aren't going to last. So we started out here, US CPI in goods is accelerating very high, US CPI in services going in the opposite direction. We take a look at China, and as you just pointed out, Emil, and the producer prices, they match up much closer with US services than US goods, which tells you in particular November and December, big time slowdown in whatever's going on there, because the monthly CPI rate for December in particular was hugely negative.
And again, we're not complaining or excusing is the word I'm after. We're not excusing or somehow diminishing. That's an even better word that I want to use. We're not diminishing the unpleasantness of goods increasing, especially during a time when the labor force participation rate in the United States is awful. This is bad news. We don't like it, but it's just, don't look at the Federal Reserve, don't look at the central government as creating too much money as being explanatory for what we're witnessing. Jeff, Chinese producer prices heading down, just like the services inflation in the United States. We end with a couple of graphs that show the yield curve in the United States, as well as that it's flattening. Anything else that we want to mention to the audience before we wrap up this particular article and this topic?
Yeah, and it's the same thing in Chinese consumer prices as well as producer prices. In fact, it's more extreme in Chinese consumer prices, which haven't really risen all that much at all. And here we're talking about the second largest economy, as well as one that has been accused of overstimulating and overdoing it in its own right for the last couple of years too, in some places. So if we were thinking about inflation as real monetary inflation across the entire world, again, we only find it in those things most heavily associated with US goods. The US goods, the supply shock, the frenzy that was released temporarily by Uncle Sam's helicopters earlier in this year, which pushed up commodity prices, which made shipping that much more difficult and created all sorts of bottlenecks and issues like that. But it wasn't money. It wasn't actual inflation. If it was, we would see it in all these places. And I think more of the problem, more to the point, where we're getting into bond yields sorting out this inflation data for us, we're also looking at the outlook. What is 2022 going to look like? And if we're looking at the end of 2021 for clues about this year, some of those are not really good at all. Again, we have producer prices in China that are suddenly reversed hard, looking like they've made a top around October. US services prices, that third hump or the camel's head, October. Chinese consumer prices, they wouldn't get really very high at all. 2.3% on the CPI is nothing, but still, that high was reached in October. And if we match this up with the bond market, US Treasury yields and all those around the rest of the world, the Treasury yield curve started to flatten, especially at the long end, the independent end, October. So the bond market, the US Treasury yield curve has been saying since October, hey, maybe there's not inflation, number one. And number two, maybe all this inflation stuff is really starting to abate in these non-US goods areas, which is basically the entire rest of the economy. So we have the yield curve flattening since October, and now we have services CPI data that goes along with that, and even more extreme and probably even more relevant and potentially important for this year, Chinese PPI and Chinese CPI data that says price pressures are coming off maybe a little too fast. Maybe we're moving in the wrong direction too quickly, which goes along with this whole end of 2021, beginning 2022 growth scare thing.
Jeff, are bond prices telling us that these supply chain bottlenecks and imbalances between demand and supply, ordering online, is that those are going to be abating soon? Is that what they're telling us? Or they're just looking at the monetary aspect of the increase in consumer prices? Because I think some of the confusion or the problem with the messaging is the word transitory. Transitory surely means what some time period that's less than the elapsed time period since April, right? In the United States, consumer price indices started rising in April, and they've only really accelerated since then. And I think we're in January. That's too long in my book for transitory. But it's
you're
it's
right.
not,
I think that's exactly right. People have this, transitory brings up the, different things to different people. But I think the vast majority of people would say 8 months is not transitory.
Mm-hmm.
But I would counter that with when we're talking about economics. And as you know, Emil, these Eurodollar cycles are multi-year processes. 8 months really isn't all that long at all. Most people, they really want to know, okay, we accept your explanation. This isn't monetary inflation. This is caused by something else. But when is it going to end? Everybody wants to know when it's going to end. Do we have any clues about what that might be? And the answer is not really. We don't have any solid data in the bond market or elsewhere that says, okay, January, February, March 2022, it's all done. It's over with. We can speculate. We don't need the bond market for this, that inflation rates are going to come down through base effects alone. Once we get into April 2022, comparing with the fast rates of April 2021, inflation rates are going to come down for nothing more than just simple arithmetic. But that's not what we're really talking about here. What we're really talking about here is what the bond market is pricing as probabilities of a downside case over the intermediate and long run. That's what bond yields are telling us, that despite what has happened in CPIs and the economic terms in 2021, that has not translated into better probabilities of growth inflation over the longer term. If anything, if we're comparing this apples to apples, we really should be comparing the yield curve today with the yield curve in, say, 2018 or 2013, 2014, or something like that. Really, we should be comparing it to the yield curve pre-crisis. And what the yield curve is saying is that there's almost no chance that this fast CPI rates that we've seen recently are going to continue on for any legitimate reason. We don't know exactly when the supply stuff is going to fade into the history, the effects of last year's helicopter, whatever. We don't know when the goods economy is going to finally cool off and disinflate itself, but we do know that the chances of that happening at some point in the not too distant future are pretty almost certain.
In part 2 of this episode, we're going to talk about the bond market and what it's telling us, because it's at all-time 2-year highs. And what might that mean? It might mean inflation, it might mean a bond ride, it might mean the end of the world. But would you believe it that we recently had such experiences? And we're going to look back at those all-time multi-year highs in previous years and see what they might tell us about the future.